Yeah, thank you for joining in. We will be just starting in just a couple of minutes. Anybody want to put in where they're located in the chat box? See where everybody's from. See San Francisco Bay, Sonoma, Tacoma, Washington, Cincinnati, Ohio, Rob in Denver. Hello from Scottsdale, Arizona. Love Scottsdale. Randallstown, Maryland. Fort Worth, Texas. Sacramento. We're definitely from all over the country this evening. Houston, Texas. I was just in Houston a couple of weeks ago. It's amazing weather. Actually, it was fantastic. The weather was like that all the time. Houston would be 10 times the population it is, because it was really beautiful. It's really nice. San Francisco Bay Area and Montana. Hi, Jim. Okay. I think we are ready to go. Think we're ready to go, Jeannie?
I'd say let's roll.
Let's roll. Okay, sounds good. All right, guys. Well, hello, everyone. And thank you so much for joining our investment webinar for the Ridgmar Luxury Townhomes in Fort Worth, Texas. My name is Mike DeRosier. I'm starting off this webinar today, and I'm joined by our partners that I'll be introducing to you shortly. We're very excited to offer this opportunity for limited partners to invest with us in such a terrific value-add property located in such a strong market of Fort Worth, Texas. This offering is a $50,000 investment minimum with a 7% preferred cash-on-cash return and a 19.1% average annualized return. We'll start off with a quick introduction of the management team and a bit about our buying strategy. Then I hand it off to some of the team members to explain more about the detail about the property and the market, the property and the market comps, and the financials. At the end, I'll explain the steps on how to invest with us, and we will open it up for questions. So please put any of your questions in the Q&A box at the bottom, and we have Christine DeRosier monitoring the Q&A. She will relay the questions to be answered at the end. We do expect this opportunity to fill up quickly. It is a first-to-fund offering, so we will have a poll at the end of the webinar to let us know of your interest level. This is a soft commit, but we will then contact you first to reserve your spot. We expect the webinar to be about 45 minutes, and we'll be sending out a recording to everyone who has joined today. Okay, first, the most boring slide of this presentation. Our lawyers insist that we show this slide on every webinar and offering. This is a confidential private offering. It is not to be shared with others unless you have our permission first. We're always happy to have additional investors, but you just need to let us know before you send it out. Every investment comes with a different level of risk. Our underwriting is estimated on current projected market conditions and is subject to change. This disclaimer slide is available on the property package, and the final PPM documents will be signed before any investments are made. All right, our lawyers are happy. Let's get started. So this is a 506C investment for opportunity for accredited investors only. If you have any questions about that, please reach out to one of us and we can explain it to you further. Our management team consists of Valley of the Moon Investments, Growth Capital Group, Omni Real Estate, Omni RE Assets, and Solid Door Investments. As a team, we pull together our experience and skill sets and capital to create a strong management team that can confidently take these large properties from purchase to renovate, then to exit at resale. This allows us to execute a business plan efficiently and cost effectively to maximize profits, which is shared by the limited partners and general partners. This is truly a terrific team that works well together. We have we have properties in 5 states, proven track record of growth, and 1,208 units combined under management. As a team, we spend many hours analyzing properties and growing markets for the right opportunities at the right price. We always underwrite conservatively, and we submit many offers before any are accepted. This is just part of the process to get the right deal. So this page is some of our properties. We have Village East is 132 units in Denton, Texas, which is a suburb of Dallas, MSA. We have Viridian Place is 228 units in Dallas, Texas. Nightscape's a beautiful A-class property in College Station, Texas, just a mile away from Texas A&M. And the Hudson Apartments is 253 units, which is in Independence, Missouri, a suburb of Kansas City. This is also part of a 3-property portfolio purchased together, totaling 426 units all at the same time in Kansas City. Okay, our team strategy is primarily looking for value-add properties but with below market rents. This is usually due to the property being outdated or poorly managed. This allows us to take over the property, invest the right amount of capital to bring it up to the neighborhood standards, and allowing us to increase the rents to the proper market rent. It increases the NOI, the net operating income, which increases the value of the property. And once a property is renovated and stabilized, it's time to sell, and we do it again. We carefully research emerging markets within the U.S. that show strong upward trends in population and job growth. These 2 components combined with selecting a business-friendly or landlord-friendly state allows for the best chance to obtain high returns on these multifamily investments. We renovate organically as the leases expire and offer good tenants the opportunity to move into the renovated units so we can renovate theirs. Our goal is always to keep good tenants and make the property a better place to live. We typically underwrite properties for either 3 to 5 year hold or 5 to 7 year hold. This depends on the market conditions and the amount of renovation needed. We always choose what's best for the investment and the investor returns. We invest our own money into the deals. We share profits on the exit along with our investors after we have successfully completed our business plan. We always try to be conservative in our underwriting to keep the investment safe, and we like to underpromise and overperform to our investors. Some of the benefits that we love about multifamily, just to name a few, obviously the security of real estate being a hard asset that is increased in value with inflation and offsets the lower value of the dollar. It's always a concern. The longer term hold is a lot less volatile than other investments as it's not susceptible to panic selling or emotional selling like you see in the stock market. These large properties typically give off a very strong, steady cash flow and not really affected by just a couple of tenants moving out at a time. So it makes it a safer bet. Of course, the appreciation on the property over the whole time and the forced appreciation we get from just renovating the units. Of course, the amortization from reducing the loan amount and the depreciation, which is a huge tax benefit, which is shared with all the investors. We do a cost segregation, which is a terrific tax savings on large properties like this. Chip will explain more about this later. And typically they receive higher than average returns compared to most other investments. Okay, about our team. So first a little bit about Growth Capital Group. My wife Christy and I currently are general partners or key sponsors on 500 units in Texas, Las Vegas, and Kansas City. We have owned and managed many single-family rentals. I've been a CEO of my own advertising and marketing business for over 32 years. Christy is our investor, our relations and research specialist, and 30 years of administrative management. Christy and I started the extensive multifamily and syndication training just a few years ago and have worked extremely hard to get into our first deals. I hold a California real estate license, but I don't use it for these transactions. Christy and I both enjoy being part of these acquisitions and add value to the communities while giving investors an above average return. We have Chip and Jeannie Allen from Valley of the Moon Investments. They are team partners with extensive multifamily and syndication training. Their GPs or LPs on over 500 apartment units and 600 mini storage units. Chip is a funding and asset manager and is a retired real estate and construction attorney. Jeannie is an acquisition specialist and retired from inventory management for national corporations such as Levi Strauss and the Ross stores. Next, we have Jig and Sejal Patel from Omni RE Assets. They are team partners who live in the Dallas-Fort Worth area and are very close to the property. They are also our so-called boots on the ground, if needed, and our prime asset manager on the property who manages the manager. Jig and Sejal are GPs and LPs on over 400 units in Fort Worth and Plano in Texas and know the market extremely well. Jig is 15 years in IT management and Sejal is a licensed realtor in the DFW area. Last but not least, we have Brian Ayers and Rebecca Stupnago from Solid Door Investments. They are GPs and LPs of over 500 units in 8 properties, primarily in Texas and Arizona. They have over 50 million in assets under management and have brought properties full circle from purchase to renovate and sale while giving outstanding returns to their investors. They have the most experience on our team and offer a tremendous amount of knowledge in the industry. Brian has 25 years in rental management and is a licensed contractor. Rebecca is a licensed realtor and a former real estate appraiser. The combination of skill sets allow them to find, analyze, and acquire some very profitable properties. And then last is our property manager, which is Class A Management. They have 34 years in the industry, currently manage over 5,400 units with 31 properties in 37 cities and a professional staff of 112. This is the same management company we've been using for our other Texas properties, and they've shown a strong, proven track record over time. Okay, that's it for our team. Now I hand this off to Jig, who's going to discuss about the market overview. Jig?
Hello, guys. Hey, Mike, can you hear me well?
Yes.
All right. Hey, thank you, Mike, for the awesome introduction. I'm very excited to share this opportunity with you all. It's my honor to be part of this very successful team. Thank you. As a team, we love the DFW market for various reasons. We currently own 3 properties totaling about 410 units in the market, and we plan to acquire more units in the near future. Being local to the market and boots on the ground, I am excited to talk about why it is such a great market to invest in. Many of you probably know that DFW market, if you looked into some recent statistics, you would have found that there are a lot of good things happening in the market. It is a hot spot for real estate investments. But you may not know that Dallas is home to 24 Fortune 500 companies just behind New York and Chicago. On top of that, it is the second top growth market in the country. Job growth is the absolutely most important parameter we look at when we select the properties. The DFW market has been experiencing significant inbound growth for many years, and now the current pandemic situation has accelerated growth. DFW has added tremendous amount of jobs in recent years. Many corporate headquarters are relocating into this region. Just recently, Charles Schwab and CBRE has announced that they will be moving their headquarters offices to DFW. This news, in addition to some of the major brands, including Toyota, AT&T, Liberty Mutual, JP Morgan Chase, that have already migrated into this city in last 3 years. According to CoStar Research, in average, 1 person is moving into North Texas every 4 minutes. That's interesting, huh? This continued migration trend has increased the demand for multifamily apartments. From our research, we have found that just in second and third quarter in 2020, there was a huge spike in demand. We look for these data points because we know that this gap in supply and demand is going to push high rent and low vacancy. This will essentially increase the property value and provide a good return for our investors. One of the reasons for this influx is that the state government has done a great job giving many incentives in tax savings and providing a business-friendly culture. This is inviting more companies to move in. One of the recent examples is that federal judge in Texas has ruled that the national ban on eviction by CDC is unconstitutional. Well, with that, let's check out the economic diversification in this city. In terms of employment industries, Dallas-Fort Worth is one of the most diverse economic engine in the country. We like this because it lowers our risk. The market is not dependent on one big employer or just one industry that can massively affect your business negatively. This slide is just a nice visual to see how DFW has improved significantly in diversifying from an economic standpoint. Let's see some of the major employers in the region. As you could see here in this slide, these are the major employers within the vicinity of Ridgmar. It's a nice mixture of aviation, transportation, healthcare, education industry. Now, let's get into the numbers and see how the area is growing economically. Well, these are the next two slides, which are my favorite slides here. It shows that we are data-driven investors. We invest based on solid statistics and numbers rather than our emotions. We pull our data from reliable analytical resources such as CoStar, CBRE, Northmark, etc., and do our due diligence before even put LOI on it. This slide shows a historical trend about some key matrices. As you could see, Fort Worth beats the ideal numbers that we would like to be by far on all of these indexes, particularly talking about the median household value, where the value of the individual residential house has gone 12% up just in last year. These are awesome numbers. Now let's see the forecast. Looking at the forecast data, the numbers are looking even fantastic. Employers in Dallas-Fort Worth are expected to add nearly 115,000 jobs in 2020 alone. While looking at the rents, they were mostly flat in year 2020, but the forecast supports that rents are going to grow approximately 3% year over year. The strong rental demand will drive the modest vacancy decline. The rate is projected to decline 20 basis points in 2021. Likely, it's going to end at approximately 5.1%. These are some solid forecasts and reason for us to invest in this market. Now, let's take a deeper dive into the locations and the surroundings of the area. In addition to looking at the data from the investment perspective, we also equally emphasize giving a pleasant living experience to our tenants. We look for properties in a desirable area where our tenants would enjoy living. Here is a screenshot for Ridgmar Townhomes from Trulia.com. As you could see, the area is rated highly in key indexes. It is a very safe neighborhood. It is a pet-friendly, walkable to the grocery stores, and plenty of park for kids to play. It's truly a desirable location. We also look into school district rating for our properties that fall under. As you could see here, in the screenshot from gradeschools.com, the Fort Worth ISD has been highly ranked, and all schools have gotten great reviews. Now let's talk about the accessibility of the area. As you could see, the bird's eye view from the Ridgmar Townhomes, you could see in the center left, sorry, the Ridgmar Townhomes are located. You'll find that it is surrounded by a nice mixture of big employers, brand name stores, restaurants, and parks. You could get out of the townhomes and hit I-30 to get to the Fort Worth downtown in about just 15 to 20 minutes. That's a great advantage for any of the location. Now let's talk about what's happening in the neighborhood. I'm going to end my part by sharing some super exciting news that makes this property even much more attractive. The city of Fort Worth leadership has rightly decided to spend money towards expansion and redevelopment of the area. In our due diligence, we learned that the Ridgmar Mall now has a new owner, and they have great plans to repurpose the mall by converting 50% of the space into commercial offices. That means more jobs are coming in the neighborhood. They plan to repurpose the rest of the space into high-end retail shops and recreational spots. This will certainly make the Ridgmar Townhomes an even more desirable place to live in. With this, I'm going to pass to my partner, Jeannie Allen, to talk about property and the business plan. Thank you.
Thank you, Jig. Well, I'm as excited about this property as Mike and Jig are. Over the past year or so, we as a group have looked at probably 75 to 100 properties, looking for the right one to bring to our investors. So what makes this the right property? First, it's the Fort Worth market that you just heard Jig talk about. And then it's the property attributes. And of course, the business plan, what we're going to do with the property. So first, let's look at the property itself. At 60 units, it's the right size to take advantage of economies of scale and support a full-time on-site leasing manager. Those are both two very important factors in the multifamily world. These are two-story townhouses, making them different than the typical one-story apartment buildings in the area. So what is right about the age? At 1984, it's the newest multifamily in the neighborhood. The other properties in the area were built in the 1960s and the 1970s. So you would think that a 1984 building would be the nicest one in the neighborhood, but it's not. The neighboring properties have been updated, but the Ridgmar is still stuck in the 80s with all of the unit interiors being what we call classic units. But we see this as an opportunity as it's the basis for our value add strategy. In spite of the property being outdated, it currently has a 95% occupancy even during COVID. So with the strong Fort Worth market, we'll be able to maintain that strong occupancy once we improve the property, which takes us to our value add business plan to take this from a C class to a B class, which will generate value with the forced depreciation. The last two owners didn't keep up with basic maintenance. So now we have deferred maintenance, both interior and exterior, and we're going to fix that. So the tenants will once again be able to be proud to call the Ridgmar their home. We'll start renovating the interiors as soon as we have a vacant unit. In the first couple of years, we plan to renovate 20 out of the 60 units, and then another 15 before we sell, and potentially all 60 units. After renovation, we'll be able to raise the rents to market rate, which is about $251 on the average based upon the comparable properties in the area. We'll also be able to reduce expenses with our professional property management group that we already have experience with. Let's dig into the property amenities a little bit. As already mentioned, the Ridgmar is a townhouse style. It has private entrances, private patios and balconies, vaulted ceilings, and wood-burning fireplaces. Carports and garages aren't an automatic with townhouses, so that's a bonus for this property. It even has a washer-dryer hookups in all of the units already installed, and that gives us the opportunity to add washers and dryers for a rent premium. The units are really spacious, ranging from 900 to 1,250 square feet. Those are large living units. It's a really pretty property as well. There are mature shade trees and open green spaces on over 2.5 acres where you can see people walking dogs and kids playing. And yes, it's pet friendly, and we're going to keep it that way. The individual HVAC units provide much better temperature control in the hot Texas summer than the chillers that many other apartment buildings have. Another nice touch for braving the Texas weather is the mailbox area with a roof. The Ridgmar has a really great unit mix. It's about half and half, 1 and 2 bedrooms, with 40% being 1 bedroom, 53% being 2 bedroom. Another great feature is that it has a variety of floor plans. There's five floor plans. The 1 bedrooms have either a 1 bath or a 1.5 bath. The 2 bedrooms have a 1.5, 2, or 2.5 bath. The current owners aren't using the current owners are using one of the units as the leasing office. So that means that one unit is not getting income. We are going to be able to convert existing space into a leasing office and be able to convert that living unit back to an income producing unit. Now let's review the specifics of the value add components of our business plan, starting with the exterior. There is deferred maintenance that needs to be fixed, like repairing the foundation on one building, sewer repairs on another, and some of the balconies. A few of the garage doors need repairing or even replacing. So we'll do that. The parking lot is in great shape. It just needs restriping. Those fabulous mature trees are actually pretty overgrown, so we'll be trimming them back. Individual HVAC units in the units are terrific, but only if they work. We'll replace about 25% of the units because they are not working very well. Then we'll do upgrades, like a new exterior 3-color paint job, as you see in the photo. A few units have space to expand the backyards, and we'll be able to charge a premium for those units with bigger backyards. As we rebrand from Ridgmar Townhomes to the Ridgmar, we'll install attractive signage. We'll also be enclosing the dumpsters to make that area more attractive. New solar screens on the windows will help with energy bills and also the appearance of the property. And we'll install security cameras and LED lighting on the exterior for both beauty and security. On to the value add components of the interiors. We have about a CapEx budget of about $6,800 a unit to do all of this. And once again, there's the deferred maintenance. Some of the ceilings have some obvious patching. There are some leaks to take care of. Some of the kitchens have mismatched appliances like a black stove and a white refrigerator, and we'll take care of any needed repairs. As upgrades in the interiors, we will have black appliances consistently throughout the refrigerator and the stove. We'll resurface the countertops, add kitchen backsplashes and update the kitchen cabinets, install luxury vinyl flooring, which will replace the old carpeting. We'll reface the fireplaces with ledgestone, replace bathroom vanities, as well as updating the bathroom lighting. And of course, we'll paint throughout. This is the line item CapEx, the capital expenditures for the exterior. And I'm not going to go through every line, but it will be in your slide deck for your review when you get the recording, and you can look at those details later. Our grand total CapEx for the exterior is about $300,000. We also have the interior line item CapEx budget for your later review, and we're allocating just a little over $6,800 per unit for the interiors. I'll end the property review with a bird's eye aerial view. It's 15 buildings. They are all fourplexes, and it makes it really a nice scale for living. The property backs onto a single family neighborhood of high-end homes, creating a really lovely neighborhood feeling. We believe that we have found the right property for our investors. Now I'll just briefly take you through the market comparables for rents and sales price. These are the rent comps for the 1-bedrooms. And I just want to draw your attention to the average square footage towards the bottom, and then the next line, which is the market rent. The takeaway from that is that the Ridgmar has larger units and lower rents. For example, at the Ridgmar, the 1-bedrooms are 950 square feet. At River Park, they're 740 square feet, considerably smaller. Yet the rents are higher at the comp properties. The Ridgmar, $955 for their 1-bedrooms, whereas River Park is $1,139. This tells us that there is room to raise the rents after we correct the deferred maintenance and upgrade the units. It's a similar story with the 2-bedrooms. Oh, back one slide, please. With the 2-bedrooms, the Ridgmar has larger square footage units and lower market rents. On to the next slide. And finally, the sales comps. We paid just a little over $110,000 per unit, putting us under the average, which is $119,000 per unit. We see that our purchase price was in line with the recent sales comps in the area. And now I'd like to turn it over to Chip Allen to take you through the financials and the investor returns.
Thank you, Jeannie. Great to be here today on this webinar with everyone else. I really appreciate what Mike and Jig and Jeannie have told us so far on why this property is such a great opportunity. I'm going to spend a few minutes talking about the finances of the property, what we like to call the numbers. But I do encourage you to review the business plan and the investor documents that you have access to at the end of the webinar. So let's just take a quick look at a couple of the highlights. First, we have a 7% preferred cash-on-cash return to the investors. That also, at the end of the life cycle of the property, that yields 19.11 total projected return. We're going to be raising $2.3 million with a minimum investment of $50,000. So this opportunity is available to a lot of people that wouldn't be able to get into other deals. Those, just by the way, the 7% preferred cash-on-cash returns are paid out quarterly. And last but not least, but important to our project here is we're getting a bridge loan on this property. The bridge loan will have an interest rate of 4.2%, which is about 50 basis points below the agency loans that are now available. Historically, the bridge loans have been 2 to 3% above agency loans. So you can see quite an advantage we're getting with that. We'll also have a rate cap to protect us from the future increase in the interest rates. Now, one of the other big advantages of a bridge loan is that we have a 75% loan to cost ratio, which means that the loan covers our capital expenses and improvements, instead of you, the investors, having to pay for those improvements. And at the end of the term of the loan, we have an opportunity to refinance it without penalty. This slide just shows us the cash on cash and the equity returns for a $100,000 investment, something you can spend some time with looking at later. The key points are that the AAR is 19.11%, and you'll be receiving about $60 or $76 or $77,000 back on your investment. This is the sensitivity analysis that we do to see what the property would sell for at the time that we are going to be putting it back on the market. As you can see, we've done a very conservative cap rate at resale of 5.5%. Right now, the Fort Worth market is having a cap rate of about 4.5%. If that market rate continues at the time we get ready to sell, we'll be able to garner a much larger sale price on the property. This slide just shows us the source and use of the funds as we take over this property. And it's what important to see is we have enough money to purchase the property and to do the $605,000 in capital improvements on the property. The net operating income for the property right now is $237,000. By the end of the first year, we're going to be able to increase that by over 50%, which means we'll have a much higher value to the property and a value to your investments. This is a 5-year pro forma, which you can look at later. It sets out the amount of income that's received each year and the expenses that are going to be against that. The big thing to look at here again is that you have the cash-on-cash returns of about 4.6% in the first year, 8.2% in the second year, and then in the 17% range in the years 3, 4, and 5. And here I just want to show you that for the first year, we're going to keep the rent escalator at 0%. It's conservative, but we want to make sure that as we get the work done on the property, we're not projecting higher rents than we really have. So at the beginning of our webinar, Mike made a comment about cost segregation. And so what is cost segregation? Congress and the IRS recognized a while back that there are different parts of a property that wear out at different rates. Rather than depreciate our property over the life of the entire property, which would be 39 years for multifamily housing like this, we will engage a specialist to segregate the different components of our property, such as the roof, the flooring, the appliances, lighting, fixtures, plumbing fixtures. and apply those appropriate rates to those components. This will allow us to take a substantial depreciation in the first year, which you can use to shelter your investment in the property. However, you should note, as the footnote says, please consult with your CPA as to how this will apply to your individual tax situation. And now I'd like to turn it back to Mike, who will show you how you can invest in our property.
All right. Thank you, Chip. Well, it sounds like most everybody's still with us. Thank you for listening to that. We're just about done. I want to talk a little bit about the next steps. Again, this opportunity is expected to fill up quickly. We just feel it's a great property in a great area. We've already had a lot of activity with investor interest. We will put up a poll shortly that you can tell us your commitment level and your interest. Okay, first you will need to get access to the portal. This is through an invitation only. So you will need to get in touch with one of us, or if you soft commit on the poll today, we will automatically send you an invitation. That gets you into the portal. You set up your username and your password, you log in, and then you can review the offering in the portal, and then you subscribe to the investment. This will then, you will then sign the PPM, the private placement memorandum, in the portal. These are the legal docs from our attorney for the syndication. Be aware there's a lot of pages, so be prepared. Here you'll be able to see the instructions for wiring funds, and you can then track your investments from this portal at any time, where we update the financials and the information on the investment. Okay, we'll put up the poll now. And please let us know your investment interest. No one else can see this, but it gives us an idea of how much is committed and allows us to invite you direct to the portal. So we will then reach out to you the next couple of days to see if you have any further questions or to help you get assistance with that. Again, this offering is a first to fund. We expect it to fill up quickly. We can now open to any questions through the Q&A. Christy?
Hi, Mike. I have a question for Chip. Who is your bridge lender? And did you say that you can extend loan terms without points? Chip, you're on mute if you knew that.
There we go. I had to click it a couple of times to get it to unmute. Currently, the bridge lender that we have we have a confidentiality agreement with them until such time as the loan is actually closed. So I can't disclose who it is. The second part of that question, I believe, was having to do with us being able to refinance the loan. Is that correct, Christy?
No, he's asking, or I'm sorry, the person is asking, can you extend the loan term without points?
The loan as we currently have it is a 3-year interest-only loan with 2 one-year extensions, and those are without points.
Okay. I did have an email come through earlier today asking when the funds need to be turned in.
Mike, you want to address that?
Okay, so we will start the funding I believe that's going to start happening tomorrow. So we will get you into the portal, we'll go through that process, and funds will be transferred here within the next 2 weeks.
Okay. I have another email from today earlier asking, will I be involved in the day-to-day management of the property, being an investor?
I can answer that. So as a passive investor, you have access to everything that's going on with the property, but you're not in as a general manager. So the general managers or the general partners are the ones that are in the meetings with the property manager, the weekly meetings, and all the financial updates. But as a passive investor, you are certainly a partner on the property and have access or the ability to review any of the information on request.
Okay. What is the waterfall structure?
Yeah, Christy, I'll take this one. So we have this set up, it's projected as a 19.11% AAR return to our investors. The waterfall that we have set up is a 70-30, and then once it hits 20%, it would be a 50-50. So in this scenario, there is not a waterfall built in. There is not a waterfall that would be paid out. If we exceed what we have projected here on the screen of 1911, then there would be a 50-50 waterfall. Anything above and beyond 20% AAR return to our investors. We do this as a performance measure. It encourages us as operators to do above and beyond what we have projected for our investors. And then this equally motivates us to do more, to do as well as we can, and then we both profit.
Okay. Are there any sponsor fees?
Yes, we have, there's a 3% acquisition fee that goes in for the, to the property at closing.
And we have, yeah, the asset management, we are charging 2%, Mike, and that's all. That's the only fees that we have on our structure.
Correct.
Okay.
But let me add to that, that the fees are already worked into the numbers. So the numbers that Chip shared with you are the numbers that are returned to you. We've taken out all the fees already, the 7% cash on cash, the 19.1% average annualized return. Those are the numbers that come to you. We don't take any additional fees out. The fees are already calculated in.
Yep, that's a very good point. Thank you. Thank you, Jenny.
And Darpesh would like to know if he can use his 401k money to invest.
I can take that, Christy. Yes, absolutely. We accept funds from 401k. In fact, that's I would say that's how I started my investment. My first investment in multifamily was from my 401k. We have our partner, solo401k.com. We can get in touch with them, Darpesh, for you and get started if you are interested.
Thank you, Jig. Bimal has two questions. How many properties has the management group successfully exited so far?
Yeah, I can take this one. So we are in the process of exiting one of our properties that is under contract to be sold as we speak. And we did a fantastic return in the last 3 years, less than 3 years of renovating that property, going through that. So, we have 9 others that we're in the process of going through at the same time, and they are performing quite well. The other question that I wanted to answer while I had the microphone is who will be responsible for executing your value add strategy? That is, as a group, we as a team are doing that. My background is general contracting, and I will be leading that with our property manager. And then as far as the vacancies during the value add, we'll be pushing the rents to that next level. And as people move out, we will be doing the renovations. So we're not going to be doing the renovations while people are living there. The ideal is that we will do 2 to 3 of them a month as they become vacant. And so that's why the first year we went without showing the rent bumps, because we can't control when people are going to move out. But over the course of the cycle of a year, we've been pretty good at trying to figure out how many people are going to move out. And most of the times what happens as they move out, as we renovate the units, we usually have more transfers because people, again, they like where they live. They're going to want to transfer to a renovated unit. And so that's usually the case where we'll have about a 40% conversion of transfers on our property. And that's been the norm so far.
Brian, I could add a couple of things on the exit side. Not necessarily my own experience on the exit. However, my investments as an LP, which are in Fort Worth, the projection was to exit at 5 years. The team has decided to exit at 2nd year because they are getting the price that they were projecting at 5th year. So again, the great news, or that shows how Fort Worth is desirable, especially from the return perspective.
Bimal's second question is, what is track record of returns on investment to investor for units currently under management, projected versus actuals?
I can take a stab at that one. So on a lot of our properties, it just depends on what the strategy is going into it. We have a similar property in Red Oak, townhouse style. And what we love about townhomes is just their appeal in the marketplace. They're right behind single family rentals, in terms of garnering that appeal. We've taken it and increased the rents on that property 44%. Conservatively to our investors, we showed that appreciation is a lot lower, knowing kind of going into it, the appeal of the market. When we originally purchased that property, it was $760 on average for rents, and we've taken it all the way to $1,075. The same thing, with our Mesa property that we had, kind of similar in appeal, being a hot market like Fort Worth is. And on that property, we've increased the value of the overall property from 7.4 million to 13.1 million in just under 2 short years. So we do have a lot of track record as far as, being able to identify those properties that are most appealing and will garner kind of the highest rent bumps, that we can do it and sustain it in the marketplace. So we're really excited to have this property and add it to our portfolio, because townhomes themselves are just very desirable. And, in a hot market, when you can't find a home to purchase, sometimes, a few people are limited to, townhomes until they can, find what they can afford. So we're excited to be in this one.
Thank you, Rebecca. Darpesh would like to know, how long is the lock-in period?
Go ahead, Jake.
All right. Our plan for this property is to lock in for 5 years. However, we are anticipating a refinance at the end of the 2nd year. We are projecting to basically give you at least almost half of your principal back and exit at the 5th year. I hope that answers the question, Christy.
Okay, thank you, Jake. Another question from an anonymous attendee. Will you provide a spreadsheet of your properties and how it compares to the pro forma? Who would like to take that one?
Sure. I mean, we can always put together something that we can email out to anyone that's, interested on kind of where our properties are, how they've performed, and how they stack up compared to this one.
Yeah, we need to find who this anonymous is, right?
Right. So we can send it to them.
Miss would like to know, what is the sponsor cost at the end sale of the property?
So typically we do a 1% capital transaction fee. There's a lot of work that goes into selling the property. And so on the exit of the property, there'll just be a 1% fee that goes to the management team for putting together all the extra work that kind of goes into what it takes to list and sell a property.
Thank you, Rebecca. Going into the property, how do you determine when to raise the rent? And is that based on the end of the lease agreements?
I can answer that. So our initial plan, because we feel that the property is the rents are under market, they are not even charging for the garages at this point. They're charging the same price for a carport as for a garage. So we're going to immediately go in with a small rent bump, a little more on the garages than on the carports. And then as the tenants either with their leases come up and they decide to leave, then we will renovate the units. And if they don't leave, they'll pay the additional rent, and we'll just wait for another unit to come available.
Thank you, Mike. Brian, this one is towards you. You answered it earlier, but who will be responsible for executing your value add strategy? How have you accounted for vacancies during the value add execution?
Right. So what we do is we do a drawn out based on when the leases expire. So back to what Mike was just mentioning, we do a hand drawn out formula. So when the leases expire, when we take over the property, we have an idea of when the lease is going to expire, and then we just kind of again adjust the rents from there. And we, again, we don't have an exact date. We don't know exactly how many people are going to move out in October. If we have 3 leases expiring, we don't know the exact number, but we do have a plan to get the rents that we want. And if they do move out, then we obviously, address that. We always try to do 30 days in advance on the lease extension. So then that way we're always ahead of the game and have our crews ready to renovate the properties. Most of these properties in the condition that they're in, as far as the interior upgrades, we should probably be able to do majority of them within a 10-day cycle, 2 weeks, 10 business days of renovation from beginning to end for what we want to do. And we'll have everybody standing by when those units come available to do that.
Great, thank you, Brian. Devang is asking, any referral rewards and who is eligible to invest? Example, a non-citizen, can they invest?
Yeah, I can answer that. So we don't allow referral rewards. That's just against the FCC rules and regulations for syndication properties. So it's just illegal for us to do that. As far as non-citizens, anybody with a US bank account can invest. So if they're a non-US citizen, they just have to open up a US bank account, put the funds in there, and then they're available to invest into the property.
Thank you, Mike. What are the key drivers of your annualized returns? How sensitive is the annualized return on the exit value?
Okay, so I can go with that one.
Thanks, Rebecca.
You're welcome. So on our exit strategy, your exit strategy is really one of the key performers for the, and metrics for the property. A lot of times it seems like when you're in a very, hot market, you may hit that performance target earlier than expected. We always like to leave our exit strategies open. And in this case, we did that. We have several different exits that we can have on that because we have our, 311, we can, roll it into a fourth year, roll it into a fifth year, and kind of decide and gauge where is the market, where are the rents at, and what would this property bring, if it were to be brought to market. We always work with our brokers as well. They'll do basically a BOV, broker verification of value kind of every year, on our property, just so we can gauge, independently from our own analysis, where they think that the properties would stand up. We do that, on all of our properties across the board, because the exit cap rate really is truly one of the greatest, drivers in whether or not we'll be able to perform on this. We did go very conservative in our analysis. Most of, Fort Worth is between a 4.5 cap and a 5 cap, and when you're purchasing the property. And so we left our exit as basically a 5.5 cap, to kind of be, conservative, but we still want to recognize the desirability of Fort Worth and in the market in general. I know there's several syndicators out there that have basically, did a flat analysis and not adjusted it at all. We like to be a little bit more conservative, with our numbers and our rent bumps and, really everything that drives the performance of the property. The other one that we had, our Mesa Townhomes, we are well above the rental income that we projected for the year, which brings our NOI up so much faster. And in a lot of cases that does happen, but that's why we kind of tend to lean toward being a little bit more conservative.
Great, thank you, Rebecca. I have another question. They wanted to know the minimum investment time, but not just the dollar amount.
Sure, I can answer that. So it's a $50,000 minimum investment. The time frame, we expect this to fund fully within the next 2 weeks, maybe sooner, but it is a first to fund investment. So basically, when it's sold out and it's filled, and then that's it. In our underwriting, we have calculated, well, we're going into this with a bridge loan, which is a good interest rate, but still in year 2, we're looking to refinance. So we'll be renovating the units, or a large portion of the units, which is going to raise the income. We'll refinance it at that time, and at that time, we expect to return 50% or more of the investment money to you, or to the investors.
Okay, that's all the questions that I have. Oh, and Amit, let me know that yes, that's correct, that you did answer his questions correctly. Thank you.
Good, excellent.
Okay.
Well, thank you everybody for joining in. This last slide obviously is our contact information, so please reach out to us with any questions. We'll also be sending out a recording of this webinar, and look forward to having you as investors with our property in Fort Worth, Texas.
Okay.
I appreciate y'all coming on. Thank you very much.
Thank you.
Thank you guys for joining. Appreciate it.
Thank you much.